Hello, good afternoon, good morning, everyone, depending on time zone. Welcome back. The quarter's gone pretty quick. Feels like we were only here a couple of weeks ago with Bruce and Mark. Looks like a pretty good quarter. The format will be the same as always. Bruce will be given a presentation, which will probably last around 15 to 25 minutes, and then we'll go on to the audience Q&A. There is a Q&A button, so please post in your questions whilst Bruce is delivering his presentation. Um, Bruce, yeah, good start to the quarter. Looks like the plan's working. You must be pretty happy.
Yeah, thanks, Peter. Yeah, definitely a very very happy with this quarter, given it's the first quarter since we announced the new business plan for Thunderbird. And yeah, thanks everybody who's online for joining again. As Peter said, same format, same slides, updated. So with that, I'll get into this. The So same general intro. As always, I'll focus mostly on Thunderbird and the ramp up there. Thought it was worth mentioning, given that we had a couple of developments on our other projects during the quarter. At South Atlantic, RGM were able to declare a maiden resource across the two larger deposits there at Retiro and Bouguereau. 771 million tonnes at 3%, which is more or less in line with the exploration target we'd identified when we started getting involved there. So we're pretty happy with that. It's got an interesting assemblage. And the other thing was they did get the installation license for Central Retiro during the quarter. So while there's other approvals required, I think that was pretty important to show that we can continue to progress approvals in that part of Brazil. And the other piece in Sri Lanka with our investment in Taprone via Capital Metals, we did follow our money alongside a new strategic investor from Sri Lanka who is looking to actually largely fund the build of that project through secondary listing or listing the local subsidiary in Sri Lanka plus some debt instruments. So that was quite encouraging, and we followed our money there to protect or effectively maintain our 10% interest in the associated rights we have. In terms of Thunderbird, just the obligatory pictures, pit on the left. You can see obviously the pit in the background. In the foreground is waste clearing activities, continuing with drill and blast, and now with our new contractor RE Group in there with the larger excavator and trucks. And we have seen a step change in productivity in waste mining as a result of both drill and blast and the new gear with a new contractor. There's still ongoing optimization there. They've just started, but we're very pleased with that and are confident that we're ultimately going to get the waste mining capacity we need to increase our ore mining rate. The pit in the background, probably comment I would make, as the pit gets bigger, you can see that the pit's actually quite clean. The wall's quite clean. It stands up very well. It's being kept, it's very orderly mine, and you can actually see the use of the oversize to build the wall. So you can see how we're starting to develop the first of the cells for input tailings disposal. And its general progress in mining is impressive now. On the right hand side, process plant from late in the quarter. In the foreground, a lot of ilmenite in the fingers, drying before loading into the trucks to go to port. In the background, zircon concentrate stockpiles and the process plant sitting there. So not a lot of change there, but process plant continues to run really well. So in terms of an update on the business plan, probably key points here. The plan on the left-hand side is exactly what I presented in the quarterly and at the last webinar. What we thought we'd do is probably focus on what we've done in the quarter, sort of what's our rate of progress. So recap key elements. The drill and blast and transition to a new waste mining contractor with a larger fleet designed to increase our waste mining capacity so we can uncover more ore to increase our mining rate, ultimately to the ability to mine at up to 16 million tonnes per annum. Although in reality, the focus is on keeping the process plant full. So once we've got the expansion to the mining, as grade varies and so on in the pit, what we'll find is there are times when we will need to mine at 16 million tonnes per annum equivalent in order to fill the process plant, but there will be other times when we mine at less than that. So I would describe it as become more like a normal mining operation where we'll be process plant constrained and varying the mining rate to ensure the process plant stays full. With the process plant full, as we've indicated previously, we expect to see concentrate production increase. We have the capacity to haul and ship that. And overall, we are looking for a reduction in unit costs as we increase production. Progress today, said drill and blast has been in place now for basically 6 months. We have seen that has really made a big difference to the diggability of the waste. I'd say we're still learning the optimal way to blast and drill and blast, and that continues to be optimized. But it's optimization. The blasting itself is very effective. New waste mining contractor with their larger fleet, mobilised by the end of May. First full month of waste in June. Seen a step change in the sort of daily waste movements, and we expect to continue to ramp that up to achieve the waste mining rates that we need. Again, similar to, in fact, probably even more so than ore mining, the strip does vary as we move around in the deposit. So there will be times when we mine less waste, times when we mine more, and we need to have the capacity to be able to handle that variability. Pleasingly, at the DMU, we've managed to achieve record production for the quarter, but equally record production in June, where we pushed over 1 million tonnes of ore for the month. It was a good step up on where we were before. It shows we're clearly on that path to the sort of 16 million tonne equivalent, but we're not there yet. I think it's good progress, but you're looking at 1.2 to 1.3 million tonnes a month of mining every month if you were to achieve 16 million tonnes, and there's a bit of there's an evolution still required to get there. I'm very confident we're on that path, but it is going to take time to be able to be, as I say, mine enough waste to get far enough ahead and to consistently and sustainably be able to increase the mining rate above that 1 million tonne a month. So looking at the charts we always use for consistency. So we're looking here as always effectively back 4 quarters. We look at 5 quarters, the equivalent quarter last year, and then the interim quarters. And I guess what you can see is that from the June quarter in 24 through to the March quarter, we really were mining at around that 2.5 million tonnes a month, 2.5 million tonnes a quarter. We were able to sustain that. A little bit of variation. You can see in Q4 we had that distinct step up. We mined, I think it was about 2.7, 2.8 in the end. And, with the 1 million tonnes, we'd be closer to that if we sustained that for a full quarter 3. So we're now seeing that step up in mining rate. There's a way to go yet, but we're, very pleasing that we've already started on that journey to ramp up the mining rate. And how's that translate through to feed? Again, similar story. As we've done before, the BFS is the dark blue or green line. The actual is the light, and then the dotted lines are the grades from the block. There are probably 2 key points here. Well, the main point, you can see that we've seen the uptick in rougher head feed volume, largely driven by that uptick in ore mined. And that means that whereas previously we were running around 75% of ore, of actual rougher head feed being generated based on the ore we were mining, we're now sort of circa and about a little bit above 80%. So we're already seeing that benefit that as we push more all through the DMU, we will be able to raise the rougher head feed production and ultimately achieve that design rate consistently, irrespective of the grade. Grade a little bit lower in the current quarter. That was a few things just partly reflected where we were in the ore body, but also you can see that and the block model, a little bit below the block model, partly because managing waste meant at times we were mining a bit more of the lower grade T1 ore to keep the DMU full while we were trying to avoid catching up with waste mining. So over time, when we'll continue to look and doing that at times because T1 ore is quite rich in zircon. But ultimately, we would feel that as the mining rate increases, we'll largely be targeting the ore that we had in the original mine plan. The process plant, same again, design versus actuals on both recovery and grade. What we are seeing is, now consistent with very much consistent with design. Still comfortable that as we're pushing more material into the plant, we're sustaining that good overall recovery as per design, and we are making products that are in line with our expectations. We don't have a hard target for quality. We basically are, we make what we're making a saleable product and allow that grade to vary a little bit. In terms of the ilmenite product, a similar story. Recoveries still have been above and in line with design. We're sustaining that as we increase throughput. Grade very much in line with design. We don't do secondary processing on this material, so it largely, the grade is what you get out of, or the quality of the material is largely determined by where you're mining. So what does that sort of look like in terms of the key sort of production KPIs for the quarter? We can, as I said before, you see the prior 4 quarters quite steady around that 2.5 million tonnes. The big step up in the current quarter, and then the way to think about it is that was 1 quarter of a 5-quarter ramp up plan. We are still targeting to be or have the ability to mine at 4 million tonnes a quarter by the first quarter of FY27. So effectively when we're reporting the June quarter next year, 12 months from now, we would expect to have the capacity to mine at that rate, be able to mine at that rate, and have achieved that rate during the June quarter, but not have sustained it for the full quarter. So hence we say the first full quarter at that higher rate is the quarter a year from now. In terms of concentrate production, firstly, zircon production, again, strong quarter for production, up Q on Q, consistently building, shipping a little bit above production. And then, as you all know, we did have a deferment of some shipments late in the June quarter. Unfortunately, we actually had a zircon vessel alongside the jetty ready to load when the crane failed, so we had to hold that load. And then there was a ilmenite vessel due in a couple of days later, and so we actually missed 10,000 tonnes of June sales that we would have expected to have made should we have been able to ship. We expect to catch that up in the current quarter, as well as shipping what we produce. So overall, we're looking at production to continue to increase sort of marginally quarter on quarter, building towards that higher production in a year's time, and shipping sort of what we produce plus a little bit of that catch-up shipment, or shipping that catch-up shipment. I will say that the 2 deferred shipments actually did ship in early July. So ultimately, the crane, it was unfortunate timing. The crane was down for circa a week, and it bridged the year end. So the shipments that would have been late June ended up in early July. In terms of ilmenite, similar sort of story. Sales and production more in line for the quarter. We actually, again here, we would have done a little bit of catch up shipping, but we weren't able to load the last vessel. It has shipped now. Current quarter, again, expecting production to increase quarter on quarter as we increase mining rates and to ship more than we produce. So we are looking at another record production of a record quarter of production and sales in the current quarter, and building towards that year from now enhanced production rate at the 220 to 240,000 tonnes a year of sulfur ilmenite concentrate. The cash flow for the quarter, probably personal highlight of the way I sort of think about this is, second consecutive quarter of operating cash flow positive. We don't see, certainly in a relatively restrained price environment, we're able to produce positive net cash, which puts us in a different situation to perhaps some peer operations that found themselves operating with negative cash flow, which is a very different situation to manage. There's definitely room for improvement here. As we ramp up, we expect obviously revenue to go up and costs to go up less. So we do expect to grow the operating cash flow per quarter, independent of any change in price. Other probably the non-operating cash flow elements here, the prepay. There was a net movement in prepay of about 20 million Australian dollars. We repaid the last of the first two facilities, and we did draw down another one effectively to help manage cash flow through the quarter. And that more or less was equal to the principal payment that was made to Orion. So we did make the first debt repayment on time and in full. This was a pleasing outcome. And this outcome, we still had that. We were still carrying inventory at the end of the quarter, given those deferred shipments. Just in terms of the Orion, the debt facilities, we obviously made that first repayment. I think those who were on the equivalent call a quarter ago, I spoke about the need to reshape the cash flows to align them. Reshape the debt repayments to align them with the expected cash generation given the new plan, and highlighting the fact that the original repayments, the June payment, then a step up for the next couple of 6 monthly payments, and then a decline, was based on a different ramp-up schedule, different cost, different pricing. So we're in the exercise with the lenders of reforecasting the cash flows over the life of loan and looking to reshape those payments to align them with expected cash generation from the asset. That's a process that takes time. It's not complete, so I can't make any comments about the likely outcome there, but the expectation is that we generate enough cash over the life of loan to allow the repayments to be made, just not in the shape they were originally. Probably also worth stressing that fixed repayments tend to be made on a low price forecast. So you always create a bit of room between your sort of base case expectations and what your fixed commitments are to the lenders, and we're working through that process at the moment. I think that's probably all I wanted to say in terms of prepared remarks. So happy to take questions now.
Brilliant. Thank you, Bruce. We've got a few questions rolling in. For those watching, please feel free to submit your questions via the Q&A and we'll get round to them. Just remember as well, obviously, Sheffield Resources is a listed company, so anything that's too forward-looking, they might not be able to talk about just based on the listing rules, but I think most of you sort of know what they can and can't. Bruce, just to start off with, I wouldn't mind talking to you about the market, especially in China. Can you give us, maybe bring out your crystal ball again, as I often ask? How's the
Yeah,
market looking? We've had some commentary from Aluka. How are things on the Sheffield side?
yeah. Look, I think it's interesting. There's been a lot of commentary from others and probably sort of generally in the market that they've seen price pressure in China this year, sort of softening demand. I noted that Aluka declined to provide guidance for the current quarter. So, there's obviously a bit of uncertainty there. I think what I would observe is, and it was in the quarterly, we effectively we had flat pricing quarter on quarter. I'm talking particularly about zircon, which is where we have our variable price exposure. We had flat pricing quarter on quarter. There was a slight uptick, but it was driven by composition rather than sort of underlying price. And so we thought that was a pretty good outcome. Effectively, we've been flat for 3 quarters. So effectively, since we started resuming sales in the fourth quarter of last calendar year, we've more or less had that 540-ish type pricing in net. I think what I would say is certainly, I was in China recently. There is, I think it's certainly I wouldn't say the band is playing and everything's rosy, but it also didn't feel like it didn't feel terrible either. It sort of feels like there's a bit of carrying on as we are at the moment. And I think, we expect to continue to see some price pressure in zircon. It's sort of inevitable, but I think we have a bit of a view that our product is probably more closely aligned with the way the Chinese market works today. Predominantly a concentrate market, not a big consumer of premium zircon, focused on sort of substandard, super standard, substandards, a lot of different sector mixes. Actually, ceramics, a lower proportion of consumption in China than elsewhere, more focused to some. It makes sense. China's an industrial manufacturing hub, so some of the demand sectors are those that feed more into those other sectors like foundry and refractory and chemicals seem to be doing all right. And the Chinese customers focused much more on concentrates than final product zircon. So I think I wouldn't, we're very pleased with our price outcome. I think we will come under a little bit of pressure for price, but at this stage, we're not seeing the market, moving probably dramatically in either direction for the next quarter or two.
Does the fact now that you have so many sort of approved customers, is that helping
Yeah,
with the price pressure as well at all?
yeah, definitely. I mean, if I think about a year ago, we had 3 customers, and those 3 customers had taken a lot of product and weren't ready for more, and we couldn't sell to anyone else. And that's a pretty invidious position to be in. A year on, I think we're up to 15 now. Okay, it's become less important to count them every day, but we have added more permitted customers in the quarter. We've had more new customers take a shipment for the first time, and that just means that if one customer can't take, as another one might do, if they're still processing material, it just gives us more choice. And so I think it gives us a greater ability to kind of fill out the order book by talking to a number of people at once. So certainly that has made a big difference to us as individually. It's not market based. Essentially, it means we can sell to a broader range of customers in that market.
Yeah, okay, interesting. So a few questions here. One from Chris Baker. When do you think you'll get to a steady state on waste mining removal? Do you think the mine is ramping up a little more rapidly than previous guidance?
No. I mean, I think, thanks, Chris. But, as I said in my commentary, we were always expecting, that we would be progressively ramping up. I think in terms of waste mining, it's probably less about getting up to the capacity we need and more about getting ahead. We've been a bit hand to mouth on ore available for mining. So, maybe a quarter or so to allow the waste mining to get far enough ahead. and then ramping up the mine. To fill the process plant is the key point. We at some point we're not just going to be mining flat out. We need to be mining to fit the process plant. I think to sustainably, we need to. The ramp up is all about sustainability. Can you do it month in, month out, quarter in, quarter out? And I do think that's a journey. It's not instantaneous. So we're comfortable with our guidance. Just to be clear, we're saying we will achieve we will have the capacity to achieve the mining rate in the June quarter next year. It's just we don't expect to be able to do it for the full quarter. So we're now less than 12 months from achieving that rate, which I think is a realistic time frame. So certainly at this stage, no change to our expectations about how long it takes to achieve that ramp up to the higher production level.
Okay, great. Just another question here from Chris. The DMU, obviously a critical part of the mine. Are you pleased with its performance?
Yeah, I mean, we have to be. It's performing better than it was. Yeah, again, a journey, not an event. What you find is that you move to you find new things, and it's a process of working with. That's not a piece of equipment we own. That's provided by a mining contractor. Working with them on, how do you work to continue to enhance both throughput and availability. It does make, we are mining at a relatively high rate. So being able to mine every day when you're not, all day, every day when you're not doing DMU moves is a key part of how you sustain that high mining rate. So again, there's a process there about continuous improvement around that, but the DMU's on that journey. But we're definitely not there yet. It's going to take time. The screen optimization, for example, which we've talked about before, we haven't done that yet. We're doing the work, but deploying the new screens is probably still a quarter, probably last quarter of this year is the soonest that will happen. So there are still things happening that will need to happen to fully get that ability to mine at that 4 million tonnes a quarter equivalent rate when we need to.
Okay. Another question here from Anonymous, but basically asking whether or not there's an opportunity here for cost reductions moving forward.
Yeah. Yeah, I mean, I think the simple answer is yes. I think probably the focus we've had has been we've been very focused on making sure we can lift the production. I think the reality is we need that. We need to be at or near design. Throughput is what gives us the a sort of most sustainable business model. Then the focus. I mean, it's not that there's no focus on costs, but as you get more like steady state, you have a greater ability to understand the cost and look for the opportunities. Inevitably in any new operation, particularly when you're chasing production to start with, you do build some inefficiencies into what you do. And, we're certainly looking for the opportunity to reduce, not just to have unit cost savings through increased production, but also to actually look for opportunities to reduce overall cost. And that is a big part of what we'll be looking for going forward. I think we see that as, again, we've modeled and designed and we're working on the business as if there's no magic bullets here. We need to make it work with this cost base and these prices, and cost savings and so on would be upside from what we currently are anticipating. But certainly I do believe there's opportunity to reduce costs over time. Or reduce, as we produce more, total costs will go up, but that we'll have the opportunity for cost reductions irrespective of what our production rate is.
Yeah, okay. All right. So especially on a per ton basis as you ramp
Correct,
up.
yeah. So the per ton will come down because volume goes up, but we will also be looking to try and compress the costs where we can as well. So a combination of the two, and definitely targeting. The idea is as we're ramping up and growing revenues, we're definitely looking for, and I think I've said it before, we have a 50% cost, more or less 50% fixed cost base. So as you increase production, you are looking for sort of circa half of that to sort of flow through as margin.
Yeah, no, good. Just going back onto the zircon market,
Mm.
Obvi- Obviously, I remember when you were first setting up the mine, and a lot of the narrative around the zircon market was obviously we had JA that's coming to the end of its
Hmm.
life. There seemed to be this deficit forming. Do you still have that view looking forward a couple of years? Is there still a supply
Yeah.
crunch coming?
Yeah, I mean, I think, yeah, there's probably two big, I think the big thesis about there are some significant sources of zircon that have been in the market now for an extended period of time and are nearing the end of their mine life and are going to be difficult to replace remains true. So JA, a couple of years out is definitely into the, it's going to close. And I think Aluka themselves, I think it was in the previous quarter, or can't remember, there was an update where they talked about it that, they are focused on a couple of life extensions associated with it, but those are very, very different deposits. If you actually look at a grade, sort of zircon grade, heavy mineral grade, they just look like ordinary mineral sands deposits. They're not JA with the very, very high zircon content. So I think they might provide some life extension, but they're not going to provide the volume that came out of there. Um, we still haven't seen a decision to proceed with Zulti South at Richards Bay Minerals, which means that RBM continues to probably slowly decline, through the end of the decade. Tronox is maintaining production. So if you look at the traditional big three, there's a reasonable amount of production to come out, probably on a 2 to 3 year view. Not today. The capacity's there today. Probably the other component, which is sort of interesting, is that we have seen concentrates flowing from places that people didn't traditionally associate with. So, there is more HMC shipped from Mozambique today than there was previously into China. While it doesn't contain a huge amount of zircon, it does contain zircon, and so that's sort of incremental zircon. We've seen a bit more out of Brazil. We've seen out of places like Nigeria, which traditionally did not export a lot. Sierra Leone. So I think there's been in the short term, there has been a little bit of I think this is always a little bit the way that there is probably a bit more flex capacity than people imagine. And certainly with China very focused on concentrates, we had seen sort of new interesting sources of supply for concentrates, which add up to a reasonable amount of zircon, but they don't replace JA, for example. It's very difficult to replace an asset like that.
Yeah, interesting. Okay, sorry to be flipping around, but we're going back to cost again, Bruce. Um, Someone here just asking if you could just explain why we had seen a bit of a jump from in the last 2 quarters in cost. Was there anything in particular that may have caused that?
Look, a lot of it is the transition costs from in the waste mining is a big part of it. So in the March quarter, we did have, we were starting drill and blast. There was a transition from the previous mining method to that, and we were demobbing the previous waste mining contractor. Then in the June quarter, we obviously we had a temporary contractor in Manic, a local contractor who kept waste mining going in the interim. We had mobilisation associated with the new mining contractor. So there was a bit of one-offs associated with that transition. Certainly, we're comfortable that the underlying cost base is what it was. It's not. We don't at a given product. I think previously we'd said, if we were sustaining that 2.5 to 3 million tons a quarter of production, we expected 55 to 65 million a quarter of C1 costs, and that's still our expectation that's where our true cost base is. Obviously, as we ramp up, that cost is going to go up. By definition, we are going to move more material, but we expect that to result in a unit cost rise. So we certainly don't believe that the last couple of quarters reflect a permanent change in underlying cost.
Okay, good. Just moving on to Capital Metals, obviously you followed your money to keep the 10%. I think you mentioned in there that you that also kept your rights. Would you mind just explaining a little bit around, I guess, what the attraction is to the deposit
Yeah.
and what the rights are that you've kept as well?
Yeah, I mean, the second part first, the rights, I mean, in essence, we have an anti-dilution right, which allows us to maintain the 10%. If we drop below that, then, while you might reach an agreement with the company to do so, we don't have a right to maintain our share. And we have a board seat and some things like that. So, those are our rights. I think that's, if we didn't like the project, we wouldn't have followed our money, that we wouldn't have done it in the first place. I think, what do we like about that project? I mean, I think fundamentally, and we've seen this in the current quarter, that, they're drilling there. I've always said this, Sri Lanka, very high grade. They're small deposit, but very, very high grade. And when I say very high grade, in situs can be 60, 70%, like at parts, and averaging, well into the 10s to 20s type range. They also found a deeper layer, which we always expect because the historical drilling was quite shallow. So the resource is a decent size, but because of the grade, it enables a low capital development. You don't need to move a lot of tons to get a reasonable amount of production. And because of that, you can actually operate at a relatively small scale and have a good business. So the expectation is that that mine can get into production for sort of, I think it's in that 20 to 30 million US dollars range, which is pretty rare. So we think that's quite an attractive proposition overall. And interestingly, the development in the quarter, local partner who sees that is the kind of funding that could actually be provided within Sri Lanka, from, probably not the only within Sri Lanka, but effectively via Sri Lanka, which is sort of interesting. So then you have that alignment between, the development and local interests and so on. So I think we like the project anyway. The deal with the Sri Lankan group, I think, just enhances the likelihood of it happening, and probably a clearer path to funding, and potentially funding based on a view of value in the underlying entity rather than Capital Metals' current market cap.
Okay, all right. So it sounds like all goes well. That could add some pretty good value to Sheffield. I guess what's the plan moving forward? So say it goes into production, or obviously it becomes a bit more valuable. Is the plan to become more involved in that project, or is it just to retain
Yeah.
and increase in value in what you already have?
Look, I think, base cases, we retain what we've got and it increases in value. I think we need to be, I think everybody understands this, that we're very focused on Thunderbird. Thunderbird is not generating cash for us. So, I think, if I had a magic money tree, would we be interested in, being, would that be an attractive investment for us to be more involved with that project? Yes, but we don't have a magic money tree. So we're very happy with, the 10% stake. We see that should grow in value as they progress the project, and we'll keep monitoring it. We'll see what happens, but it's not something that we're going to be, we're not in a position to make any sort of material investment in there in the short term. A little bit of money to follow our money and protect our position is not, that kind of cost is not really, it's not material from what's happening at Thunderbird perspective. But going and spending millions of dollars on a third party project is not what we should be doing at the moment.
Okay, cool. Moving on to the other project in Brazil, South Atlantic. Maybe we could just do a quick update on that for those interested.
Yeah. Like I said in the intro remarks, we as a result of the drilling, we've now got a resource over the two main deposits, Retiro and Bujaru. Very much in line with the exploration target, which isn't surprising. There had been a lot of historical drilling, The quality of that, we didn't, it certainly wasn't JORC compliant, lack of QA, QC, etc. But I think overall, generally showed pretty good correlation with historical. So we were able to validate that. But more importantly, we've basically got an up-to-date resource. We have a good understanding of that deposit now. So I think it's a large deposit. It's very long. It's relatively thin. It's not a deep deposit. No stripping. It sits at surface. Definitely a dredge mine. But there's a ways to go there. We've only got effectively an environmental permit on the southern deposit. We have a mining or an installation license for a subset of that as the joint venture. So I think there's a few steps required before that project is really ready to proceed into full production. And I think I also I look at current market dynamics and so on and say, now is probably not the time to be rushing to bring a new large mine into production. But very good quality product. It sits out, it's certainly well positioned to supply both local and Western markets with high quality zircon. And there's a lot of optionality in that, but we're certainly not in any particular rush to be moving into execution. We don't think the time's right and the project's not actually ready in our view. And so, we're working with the partner there. The idea would be to probably continue on the path we had, which is that there's a sort of slow burn to get the project ready for an execution decision. And when that's the case, we look to move it forward. But I think in the short term, it's more about expanding the approvals to get more of the project able to be included in an initial mine plan to support the economics of that. And that's probably aligned with where we are in the market at the moment. We are a couple of years away from that squeeze on zircon.
Yeah. Okay. So low cost, but high value de-risking.
Yeah, it's optionality, and like with all options, you want to spend money to A, retain the option, and B, maximize the value of the optionality, but you don't want to get ahead of yourselves. You're not trying to pre-exercise. So we don't see it again. We don't see that as a significant cash burn for Sheffield in the short term. But we do like the project. We'd like to retain the optionality on it.
Okay, brilliant. Well, look, I think we're out of questions from the audience. Bruce, I'll leave it to you. Any final thoughts and what are you most looking forward to in the next quarter or two?
Yeah, I think probably final thoughts, what we've been talking about. I think very, very strong quarter production wise, sales. I think we're on that path to the new business plan. We need to continue on that, but ultimately, it feels like we've started that journey and we can build on it from here. So all in all, very, very pleased with that quarter and sort of onwards and upwards.
Perfect. Okay. Well, look, we are recording. We'll send out the recording link to those who have registered and anyone who may have missed it, and it will also be on the Sheffield Resources YouTube channel and website. And obviously, feel free. There's contact details there on the screen. They'll be on the website as well. Feel free to reach out to the team. I'm sure they'll get back to you with any questions. Bruce, thank you very much for your time, and thank you everyone for joining.
Thanks, Peter. Thanks, everyone.